In 610 AD, while Europe was mired in the Dark Ages and banking as we know it didn't exist, the Quran laid down a financial principle that would govern over 1 billion people for the next 1,400 years. The prohibition of riba, interest, not high interest, not predatory lending, all interest. The idea was radical then and remains radical now. You cannot profit from lending money itself. You can only profit from actual economic activity, from sharing risk, from productive investment. Money cannot make money. Only work, trade, and enterprise create real wealth. For over a millennium, Islamic scholars dismissed this as outdated, incompatible with modern finance, impossible to scale. But today, Islamic banking is a $3 trillion industry, growing faster than conventional banking. And here's what makes it interesting. It survived 1,400 years without a single systemic collapse of the type that has destroyed every Western financial system repeatedly. No Islamic banking crisis triggered a global depression. No Islamic financial institution required a taxpayer bailout. The system that the modern world dismissed as primitive has proven more stable than the sophisticated financial engineering that nearly collapsed the global economy in 2008. This is the story of why banning interest might be the only honest foundation for a financial system, and why the prohibition that seemed medieval might be the most advanced economic idea in human history. The prohibition of riba didn't start with Islam. It's one of the oldest financial regulations in human history, appearing in nearly every major religious and ethical tradition. Ancient Judaism prohibited charging interest to fellow Jews. Deuteronomy explicitly states, "You shall not charge interest on loans to your brother." The logic was simple. If your neighbor is in need, exploiting that need for profit is immoral. Lending should be an act of community support, not a business. Christianity inherited this prohibition. For over 1,000 years, the Catholic Church banned usury, the charging of interest, under penalty of excommunication. Medieval theologians argued that money was sterile. It couldn't reproduce, so charging for its use was unnatural and sinful. Even ancient Greece had philosophers who condemned interest. Aristotle wrote that charging interest was the most hated form of wealth getting because it made money breed from money, which he considered contrary to nature. Islam codified and expanded this prohibition. The Quran doesn't just discourage riba, it declares war on it. One verse states, "Those who consume interest cannot stand except as one stands, who is being beaten by Satan into insanity." Another promises, "Allah will destroy interest and will give increase for charities." The reasoning was both moral and economic. Morally, profiting from someone's need without sharing their risk is exploitation. Economically, interest creates a class of rentiers who extract wealth without contributing productivity. It enables debt spirals where the poor become trapped, paying the rich forever. But there's a deeper insight buried in the prohibition. Interest divorces money from reality. When you can profit just by lending money, you're profiting from time itself, not from any productive activity. This creates an economy where financial engineering becomes more lucrative than actual production. Money grows faster than the real economy, creating unsustainable bubbles that eventually burst. Islamic finance recognized this problem 1,400 years before modern economists discovered it the hard way. The prohibition of riba created a problem. How do you run a banking system without interest? How do businesses get capital? How do people buy homes? How does investment work? Islamic finance solved this through profit and loss sharing. Instead of lending money at interest, Islamic banks become partners in ventures. If the business succeeds, the bank shares the profit. If it fails, the bank shares the loss. The most common structure is mudaraba, a partnership where one party provides capital and the other provides labor and expertise. Profits are split according to a pre-agreed ratio. Losses are borne by the capital provider unless they resulted from negligence or misconduct by the labor provider. For example, if you want to start a business, an Islamic bank doesn't lend you $100,000 at 5% interest. Instead, they invest $100,000 for a 30% share of profits. If your business earns $50,000, the bank gets $15,000. If your business loses money, the bank loses too. They can't just extract interest regardless of outcomes. Another structure is musharaka, a joint venture where both parties contribute capital and share profits and losses proportionally. This is used for larger projects where risk needs to be distributed. For home purchases, Islamic banks use murabaha, a cost plus sale. The bank buys the house and sells it to you at a markup, payable in installments. You're not borrowing money and paying interest. You're buying a house from the bank at an agreed price. The economic effect looks similar to a mortgage, but the structure is fundamentally different. The bank owns a real asset and assumes the risk of that asset. The key difference is that Islamic finance requires the financier to have skin in the game. You can't just lend money and collect interest whether the borrower succeeds or fails. You have to share the risk. If the venture prospers, you prosper. If it fails, you suffer. This creates fundamentally different incentives. Conventional banks want to maximize loan volume because they earn interest regardless of outcomes, as long as borrowers don't default. Islamic banks want to fund good ventures because they only profit if those ventures succeed. The prohibition of riba imposes discipline that conventional finance has lost. When lenders share risk, they can't afford to fund bad projects. They have to actually evaluate whether ventures will succeed because their returns depend on it. This prevents the problem that caused the 2008 financial crisis. Banks making loans they knew were bad because they planned to sell those loans to someone else. In Islamic finance, you can't just originate a loan, collect fees, and pass the risk to investors. If you fund a project, you're tied to its outcome. It also prevents the debt spirals that plague conventional economies. In conventional systems, borrowers owe fixed payments regardless of their ability to pay. If your business fails, you still owe the loan plus interest. This creates bankruptcies, foreclosures, and economic crises. In Islamic finance, payments adjust to performance. If the business earns less, the bank receives less. If it earns nothing, the bank receives nothing. The risk is shared, so the pain is shared. This prevents the cascading failures where one bankruptcy triggers others. Consider the 2008 crisis. Banks lent hundreds of billions for mortgages, without caring whether borrowers could actually afford them, because the banks planned to package those mortgages into securities and sell them. The result was systematic fraud, millions of foreclosures, and global economic collapse. Under Islamic principles, this couldn't happen. A bank financing home purchases would own those homes until they were fully paid off. They would suffer directly if buyers defaulted. So they would only finance buyers who could actually afford the purchase. The incentive structure prevents predatory lending at the source. The same applies to corporate finance. Conventional banks lent to companies like Enron and WorldCom, enabling fraud because they collected interest regardless of whether the companies were legitimate. Islamic banks investing in those companies would have demanded transparency and accountability because their returns depended on real profits, not accounting tricks. The discipline of risk sharing aligns everyone's incentives. Financiers want ventures to succeed. Entrepreneurs want to deliver returns. No one profits from failure, so everyone works to prevent it. Islamic finance needed a way to enable large-scale borrowing without interest. The solution was sukuk, often called Islamic bonds, though they work completely differently from conventional bonds. A conventional bond is a loan. You lend money to a corporation or government and receive interest payments plus eventual repayment of principal. Your return is guaranteed, regardless of how the borrower uses the money. A sukuk is an ownership stake in an asset or project. When a company issues sukuk, it's selling investors a share of something tangible, a building, equipment, future revenue from a specific project. Investors receive a portion of the income generated by that asset. For example, Malaysia issued sukuk to fund airport construction. Investors didn't lend Malaysia money at interest. They bought shares in the airport's future revenue. As the airport earns money from fees and operations, sukuk holders receive their proportional share. They're not creditors, they're partial owners. This structure forces accountability. If the project fails to generate revenue, investors don't get paid. So investors scrutinize projects carefully. Governments and corporations can't just borrow recklessly and let taxpayers clean up the mess. The risk stays with those who made the investment decision. Sukuk have funded infrastructure across the Islamic world: power plants, highways, telecommunications networks, and increasingly, Western institutions are issuing Sukuk too. Goldman Sachs, GE Capital, even the British government have issued Islamic bonds to tap into the $3 trillion Islamic finance market. The Sukuk market proves that large-scale finance can operate without interest. Projects get funded, infrastructure gets built, investors earn returns. But the structure keeps everyone accountable through shared risk. Here's what's remarkable. Islamic banking has operated for 1,400 years without producing a systemic financial crisis that destroyed entire economies. Yes, individual Islamic banks have failed. Yes, there have been frauds and mismanagement. But there has never been an Islamic equivalent of the Great Depression, the 2008 crisis, or the countless financial panics that have wrecked Western economies. Why? Because the prohibition of Riba prevents the debt accumulation that causes systemic crises. In conventional finance, debt compounds. You borrow $100 at 5% interest. Next year, you owe $105. If you can't pay, you borrow more to cover the interest. Now you owe $110.25 the following year. The debt grows exponentially, eventually becoming unpayable. When enough people and institutions hit this wall simultaneously, the entire system collapses. Islamic finance can't create these debt spirals because there's no interest. If a venture fails, the investor loses their capital, but the borrower doesn't owe anything beyond returning what remains. There's no compounding obligation that grows beyond the capacity to repay. This also prevents the leveraged speculation that amplifies booms and busts. Conventional finance allows you to borrow money to buy assets, using those assets as collateral to borrow more money to buy more assets. When prices rise, everyone gets rich on paper. When they fall, the leverage works in reverse, bankrupting institutions and triggering cascades. Islamic finance limits this. Because you can't borrow money to speculate. You can only invest in partnership for productive ventures. This keeps capital flowing toward real economic activity rather than financial gambling. The stability isn't theoretical. During the 2008 crisis, Islamic banks were significantly less affected than conventional banks. They hadn't invested in mortgage-backed securities or complex derivatives because those instruments didn't represent ownership of real assets or productive ventures. Islamic banks were criticized for being unsophisticated, too conservative. That conservatism saved them. The system that seemed medieval proved more resilient than cutting-edge financial engineering. The prohibition that seemed limiting proved to be protection. But Islamic banking today faces a serious problem. Many Islamic financial institutions have become Islamic in name only. They've created complex structures that look like profit sharing but function like interest. For example, some Islamic mortgages use murabaha, where the bank buys a house and sells it to you at a markup. The monthly payments are calculated to give the bank the same return as a conventional mortgage with interest. The form is Islamic. The function is identical to interest-based lending. Some Islamic banks use legal tricks called hiyal, ruses, to circumvent riba prohibitions, while technically complying with them. They structure transactions with multiple steps that, when combined, produce the economic effect of interest while avoiding the explicit form. This is the exact same problem medieval Christian bankers faced. The church banned usury, so bankers created bills of exchange, partnerships, and other instruments that charged interest without calling it interest. Eventually, the pretense was dropped and interest became normalized. Islamic banking faces the same temptation: compete with conventional banks by offering similar products, or maintain principles and accept slower growth and smaller market share. Some scholars argue that as long as transactions avoid explicit riba and share some risk, they're acceptable. Others insist that anything functionally equivalent to interest violates the spirit of the prohibition. The debate continues. But here's what's undeniable. The more Islamic banks mimic conventional banking, the more they'll suffer the same failures. If Islamic finance becomes just conventional finance with Arabic names, it will lose the structural advantages that made it stable for 1,400 years. The question is whether Islamic banks will maintain the discipline of true risk-sharing or slide into being conventional banks with Sharia-compliant paperwork. In conventional banking, who pays? Borrowers pay interest forever. Savers pay through inflation. Taxpayers pay for bailouts when banks gamble recklessly. Ordinary people pay, while banks and bondholders profit. In true Islamic finance, the structure is different. Investors profit when ventures succeed. Entrepreneurs profit when they build successful businesses. Both lose when ventures fail. The alignment of incentives means both parties work toward success. Savers in Islamic banks don't receive guaranteed interest. They receive a share of the bank's profits from its investments. If the bank invests well, savers earn more. If it invests poorly, they earn less. This incentivizes savers to choose banks that invest wisely, creating market discipline. Borrowers, or rather partners, aren't trapped in debt spirals. If their business struggles, payments adjust to performance. They don't face foreclosure for missing fixed payments. The relationship is cooperative, not adversarial. But modern Islamic banking hasn't fully realized this potential. Many Islamic banks function too similarly to conventional banks, and when they do, they create the same problems: wealth concentration, debt burdens, and financial fragility. The countries with the most authentic Islamic banking systems, Malaysia, some Gulf states, have experienced more stable financial sectors. Those that merely relabel conventional products as Islamic have seen less benefit. The lesson is clear. The structure matters. True risk-sharing creates different outcomes than disguised interest, but only if the structure is maintained honestly. For 1,400 years, Islamic finance prohibited riba and operated on risk-sharing. During that time, it experienced no systemic collapses of the type that repeatedly destroyed Western economies. Conventional finance, based on interest and debt, has produced crisis after crisis. The panic of 1825, 1873, 1907, 1929, 1987, 2008, each time, debt accumulation exceeded the ability to repay, leverage amplified losses, and the system collapsed. The pattern is clear. Interest-based systems create debt spirals, incentivize reckless lending, and eventually implode. Risk-sharing systems maintain discipline, align incentives, and remain stable. Modern finance dismissed Islamic banking as primitive, unsophisticated, incompatible with growth. But Islamic finance has grown to $3 trillion while avoiding the catastrophes that plagued conventional banks. The prohibition of riba wasn't medieval superstition. It was protection against the mathematical inevitability of debt-based systems. They always collapse eventually. First, understand that interest is not necessary for banking. For 1,400 years, Islamic finance has funded commerce, infrastructure, and economic growth without it. The claim that modern economies require interest-based lending is false. Risk-sharing works, and arguably, works better. Second, recognize that the stability of Islamic banking isn't coincidence. The prohibition of riba prevents debt accumulation, limits leverage, and aligns incentives between financiers and entrepreneurs. These aren't bugs. They're features that protect the system from collapse. Third, be cautious of Islamic banking products that look identical to conventional products. If an Islamic mortgage has the same payments and structure as a conventional mortgage, it's probably Islamic in name only. True Islamic finance requires genuine risk sharing, and that creates different terms, different risks, and different outcomes. In 610 AD, the Quran banned riba. For 1,400 years, Islamic scholars and financiers built a system that operated without interest. The West dismissed it as backward, incompatible with modernity, destined to fail. Then in 2008, the most sophisticated financial system in history collapsed. Banks that were too big to fail failed anyway. Instruments designed by PhDs in mathematics proved worthless. Regulations written by experts failed to prevent catastrophe. And taxpayers bailed out the institutions that had gambled their savings away. Meanwhile, Islamic banks, operating on principles unchanged since the 7th century, remained stable. They hadn't invested in toxic assets because those assets didn't represent real economic activity. They hadn't over-leveraged because risk-sharing limits leverage. They survived because their rules prevented the behaviors that destroyed conventional banks. History doesn't repeat, but if you don't understand it, it will crush you all the same. The financial system that banned interest 1,400 years ago might be the only honest system left. Not because it's religious, because it's structurally sound in ways that interest-based finance has never been. If this gave you a new perspective, hit subscribe. History has the answers, and I'll show you where to look.